Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I'm very excited to be joined by some of my friends down in Austin, Texas today in a REIT portfolio manager's interview. Joining me is Ryan Dobratz, the portfolio manager at Third Avenue Capital Management, as well as Tyler Lyons and Aditya Bapna from B&I Capital. You'll notice we have a little presentation up on the screen here. We're just going to share a couple of slides, the disclaimers, the firm backgrounds, that type of stuff, but we're going to then turn off the presentation for a dialogue between us. We might refer time to time to the presentation, but just know that if you are interested in getting your hands on this, just send any one of us a message and we'll be more than happy to share this with you after the fact. But our job is to basically talk this out with you guys, layering in a couple of slides here and there. So with that, we'll jump into it. Both firms have requested we showed their respective disclaimers. This is a compliance thing, so we'll leave this up on the screen here just for a couple of seconds for each firm so that we satisfy the compliance requirement. And so as we go through this, why don't we start out, Ryan, why don't you give us a little bit of a background? I grew up many years ago remembering working with your founder, Marty Whitman, considering one of the great REIT minds from back in the day. Tell us about Third Avenue, and then we'll get into B&I, and then we'll get more into in-depth conversation.
Absolutely. And before we jump in, would certainly like to thank you for hosting us. And, thank you for all of the thought leadership that you have, sort of brought to the industry by doing interviews and other things like these. So thanks. It's great to be here. As far as Third Avenue, I would really point out three items, and the first and foremost is what you mentioned. Third Avenue was founded by Marty Whitman in the mid '80s, and he's a kind of legendary value investor, but very unique in the sense that like other value investors, very much focused on buying securities for much less than the underlying value, net asset value, intrinsic value. But in addition to that, Marty stressed two other items, and first and foremost, he really focused in on companies that were really well capitalized, and in addition to that, tried to align himself with management teams or control groups that were focused on compounding capital or creating wealth over time. So very, very unique in that regard. Has written a number of great books about it. And today, we continue to utilize that approach across all of our strategies at Third Avenue. We manage a bit more than about $1.5 billion right now across the Third Avenue Value Fund, which was where Marty, really focused his time. In addition to that, we have a small cap value fund and two real estate strategies, including the Third Avenue Real Estate Value Fund, which is a global real estate fund, a mutual fund that the ticker is TERX. And it's one that I've basically been focused on for the past 20 years. And the last item I would note on Third Avenue as it relates to the real estate strategies is that we tend to be pretty unique in the marketplace because one, we focus in on those Third Avenue-like companies that are well capitalized, well managed, and trade at discounted valuations. But we also have a very flexible mandate when it comes to investing in real estate. We can invest in REITs, real estate operating companies, real estate related businesses. So a very wide universe, and we use that flexible mandate to our advantage. We've generated about 9% plus annualized returns since the real estate fund's inception back in 1998, which puts us as one of the top performing real estate strategies over most periods of time, especially over the long term, which is our primary focus. So those are some of the highlights on Third Ave and our real estate funds.
Where are you guys based?
We are based in New York. However, we've had various real estate professionals in Austin for a number of years. I've been down here since 2017. We had a couple other real estate professionals join in 20. I'm sure we'll get into it, but it's given us a unique vantage point in terms of some of the changes that we've seen sort of post-pandemic on the real estate side, both commercial and residential.
And you definitely win the best background video, the best background award of the day. Thanks. That's a great shot behind you.
Yeah.
So,
appreciate it.
Ty, why don't you tell us a little bit about B&I? Because you're not based, though you're in Austin, you guys aren't based in Austin. So why don't you give us a little bit of background about B&I?
Sure. So I'm going to introduce myself first. I mean, Ryan's a legend, so no introduction needed from him. But Yeah, my name is Tyler Lyons. I'm a REIT analyst for B&I Capital. My colleague with me, Aditya Bapna, we're both in Austin, Texas. I've been with the firm since I was an intern, and Aditya was an intern. We both started as interns with B&I. And this was back in 2020. I was getting my MBA at the University of Texas. I was using the GI Bill. Previously, I had been, yeah, hook 'em. I had been a Marine Corps officer for 8 years. Went and got the UT MBA. Started working for B&I. Loved the firm. The team was great. Really liked the culture, and just found the work really interesting, especially the global aspect. You're on calls with Singapore at that time. It was like 2 in the morning. I'm hearing about what's going on with Japanese REITs in the middle of the pandemic. So it's pretty interesting as a student. But now today, I cover the U.S. residential sector, healthcare, life science, which we'll talk a bit more about on some tours that we saw, gaming, and timber. And Aditya, if you want to introduce yourself real quick.
Sure. My name's Aditya Bapna. I'm a recovering engineer. Spent about 6 years working in the semiconductor industry, and then did my MBA here at UT Austin, and been with B&I Capital for about 2.5 years. Leaned into my tech background to help the company cover data centers, cell phone towers, as well as a little bit of office and hotels.
And then just on the firm, Dave, and what kind of differentiates us, I think our track record is very strong. Our PMs, one of those PMs, Charles Isaac, sits in Zurich, Switzerland, where we have our largest team, and that's where our headquarters is. He started the firm in 2007 with our other PM and owner, Christian Bernasconi, who sits in Singapore. And these guys have, been navigating a difficult market cycle since '07. And I think that their hard-earned expertise and our team's expertise goes into every investment decision and kind of sets us apart there. We do have a very global presence with offices in Austin. We have a research office in Austin, and then Singapore and Zurich, but we like to think we have local insight. So we have team members there that can have boots on the ground access to key submarkets. We're meeting management teams, we're touring assets, and we're getting to see what's happening on the ground. And we really believe in primary research, and that's where some of our best ideas have frankly come from. So that's a little bit about our firm. Yeah, thank you.
Why is Alaska in yellow on this page here? Do you guys have people in Alaska?
I think so. I was looking at the page. What if we had, we had a big team in Alaska? No, I think that's to show the coverage. That's part of the United States. We have a team in the United States. So
why don't you tell us, we'll keep it going with you. Can you maybe walk us through a little bit of the sweet sauce of the B&I formula, what your process is here?
Yeah, so we have a very structured investment process that we consistently follow. And you can see it there on the screen, or we'll be able to see it on the screen after this. And, we have a proprietary investment checklist that we follow every time. And we believe sometimes you're going to get investments right, occasionally you get them wrong, but if you stick to a process and you stick to that process every time, you're going to be able to pick winners. And we do that by, spreading our coverage over the entire REIT universe. And then we really dig in deep through fundamental analysis on names. We go through the investment checklist that we have, and then we have to debate those every week openly. So we have a meeting, Singapore's 14 hours ahead. So it's hard to find a time that works for everybody, but we're talking to the team there. We're talking to the team Zurich, and everybody pitches ideas. Aditya and I are pitching ideas every week, and portfolio managers and other analysts are ripping them up every week and seeing if they can make it. And yeah, that's just something that we really hang our hat on is investing the same way with the same process in every name that we look at.
Leave us with the teaser. Are you going to share with us a couple of those names that you guys have been talking about with the teams recently?
Dave, if you're nice to me, I think we'll go through a couple of those names here today.
Good answer. What about you, Rhino? Why don't you walk us through some of the sweet sauce of Third Avenue? I don't see your little sweet sauce slide here. Tell me about your guys' process.
Yeah, I mean, I think if you were to go back to maybe the Third Avenue slide, it would pick on some of the differentiating factors that we have in regards to the real estate strategy. We really point to four and kind of hit upon them. But, one, first and foremost, we're focused in on well-capitalized companies, and we're long-term value investors in real estate. So we're usually buying into companies, property types or regions that are out of favor, and on average holding those investments for 5 to 6 years at a time. So until conditions improve and valuations rebound, and we can ultimately trim back and exit those and recycle the capital. Two, we focus on total return, and we actually emphasize capital appreciation over current income. We just believe that's a more tax effective way to compound capital over time. And so if you were to look at our portfolio, you'll actually find that we own more real estate operating companies, or C corps, versus REITs. That allocation has varied over the years, but that's certainly a differentiating factor. The third point is that flexible mandate that we have, kind of alluded to it, but we can invest in REITs, real estate operating companies, real estate related businesses, so across as well as across the capital structure. So we find that our universe is probably 2.5 to 3 times larger than some. And some of our really differentiated investments over the years have come from names that you're not going to find in a passive real estate index. So that's something that's added value. And lastly, we actively manage the portfolio. The active share on our strategy is usually north of 90%. We're concentrated, but prudently concentrated around our top ideas. Typically manage a portfolio of about 30 names, but 50% of the capital is usually comprised of the top 10 holdings. So yeah, uniquely positioned, and over the years we've put a very repeatable process kind of around that strategy, sort of institutionalized the process, so to speak. And I've worked very closely with my business partner Jason Wolf on that effort, where we now have proprietary tools around each step in the process, from identifying the universe, filtering the universe, screening the universe, getting that to the initial kind of underwriting steps, and then ultimately doing the deep dive and getting that in front of not only the broader real estate team, but the entire investment team at Third Avenue, getting comments, going back, getting those questions answered, and then in certain cases getting those names into the portfolio, oftentimes putting those into a shadow portfolio that we run, of companies that we like, just at lower prices. And over the years, that's been really helpful and additive to our results. So yeah, kind of unique strategy, robust, repeatable process, and that's really, we think, enhanced the results of the Third Avenue real estate strategy over the years.
Well, thank you for that nice summary from both of you guys. And with that, why don't we jump right into the meat of this? And my goal is hopefully to find a topic that you guys don't agree upon, and that you guys present good, compelling arguments stating your case as to both why you're for or against a certain topic. So hopefully we'll find something that you guys don't see eye to eye on. Hopefully. But we'll see. All right. First things first. We got the most boring 25 basis point Fed cut in the history of REITs last week, it seems. Market had already priced in 25. Ho-hum. Whoever top ticked the 10-year treasury at 3.99, good for them. That was a hell of a trade, especially since we sit here right now at 4.143. So let's kick it off with the Fed conversation. Where are we going? What's the rate cut situation look like down the road? And how does it impact our little universe in the world of REITs, REOCs, and real estate? Who wants to go first?
I can jump in, and I'll preface my comments by saying that our primary focus is on company specific fundamentals and looking at the price to value proposition for an individual company. But I think we would all acknowledge that real estate is very interest rate sensitive, and it can very much add value to incorporate different scenarios in terms of how rates can impact valuations and the underlying value for these businesses. So in regards to where we sit today, I would just quickly mention 3 items again. And on the Fed policy, one, we think that the numbers that are coming through on CPI, at least from the Bureau of Labor Statistics, are probably a little bit stale. And as a result, CPI is overstated to what you're seeing on the ground. And the primary driver of that is actually something that's real estate related, and it's the shelter component of CPI, which is almost 40% of overall CPI. And it's still coming in at nearly 4%. Whereas if you're, looking at, multifamily rents, maybe they're up 1 to 2% nationally. You look at single family housing, HPA's, flat to even down in certain markets like here in Austin. So if you were to actually make an adjustment to that shelter component and, bring it down from 4 to say 2%, that almost takes, 100 basis points off of overall CPI. And I think it was most recently reported at 2.9. That brings it down to 2. And we have a Fed funds rate close to 4. So that's pretty restrictive, right? And so I think it's our expectation that over the next, call it 3, 6, 9 months, that Fed funds rate will continue to move down to something that you would see reported by some alternative indices like Truflation, which are closer to 2. And we think that that's actually pretty positive for real estate and REITs. And that's because on the other side of that, with the Fed fund rates being so high and real rates being, so high, you've seen tremendous amount of flows into money market funds. I think more recently, actually approaching 8 trillion. And so to the extent that the Fed funds rate comes down to 2%, and some of that capital starts to look for other yield alternatives, real estate is certainly going to be a candidate for a lot of those reallocations. And it would make sense for a lot of that capital to flow to real estate. I mean, if you look at the REIT sector, you're looking at dividend yields that are 4% plus, but the valuations are very compelling right now on both an absolute and a relative basis. I mean, on a relative basis, real estate looks incredibly interesting, right? I mean, you have the S&P trading at historically high multiples, any way you want to slice it, PE, price to sales, price to book, et cetera. Whereas, real estate is one of only 2 sectors that's really trading below its long-term averages, healthcare being another one, energy, depending on what sort of time frame you look at. But, as a result of attractive valuations and, potential reallocations, we think that comes into real estate. And as a result, we think listed real estate does well. I mean, we've tracked the discount to NAV on our fund over probably a 14 or 15-year time period. And on average, it's traded at a, high single digit discount to a look through on an NAV basis. And today we're trading, closer to 20%. So, more than 2 times, long-term average. So to the extent that the Fed fund rates comes down, money comes out of some of these money market funds, goes into real estate, that will certainly improve the valuations on listed real estate. And I think be good for the sector in terms of not only providing some yield, but some capital appreciation, which has been lacking in a lot of cases over the past 5 to 6 years.
Hashtag buy REITs. All right, Tyler, what about your thoughts?
You know what, Dave? This is not going to be an area where I disagree with Ryan. I think he hit the nail on the head. I know you I would say, yeah. I mean, we just had a discussion with an analyst from one of the banks, and he was talking about as he's starting to see generalist interests on the margins pick up a little bit, just because of people looking for yield as interest rates are cut. So I think that could, bring in additional buyers, kind of exactly what Ryan was saying on the margins, which would want to buy these companies and help REITs out.
So there was a note out, I think it was from Bank of America last week, that talked about the advisors are out there buying REITs and real estate. I don't know if you guys had seen that recently. Their advisor survey said that they were seeing a significant interest. Ryan, I want to comment one other thing that you mentioned was about the proliferation of money market. I mean, look at the growth of money market ETFs. I know it's not something that you guys follow necessarily, but you're talking about an industry that's seen multiple funds launched in the past couple of years, paying some pretty sick coupon rates for a cash account. I mean, go walk into your local bank and look what a CD is paying these days. So, something's clearly got to give. And one more point, talking about that discount that you mentioned, we've done some research at Hoya, and you're looking at the performance between the REIT industry and the S&P 500. REITs have underperformed the S&P by like over 50% over the last 3 years. So clearly there's got to be some kind of reversion here, it would seem like. And we had it for about a half a second or about a couple of minutes last week, and then we're right back along to where we were. So hopefully we'll see some reacceleration here. Well, let's shift gears a little bit, because as you just mentioned, both of you guys just saw some Wall Street analysts I'm going to be emailing that one guy you saw, Ryan, who did not come to see me. Anyways, um, you both were in Cambridge looking at some life science assets recently. I think one of you guys was at a REIT conference in New York. Give us maybe some takeaways, and more importantly, since we're kind of crawling into earnings season here over the next couple of weeks, what did you learn in your recent property tours and visiting with some of these management teams that listeners or viewers of this in the next few weeks can glean off of for both, let's say, third and fourth quarter earnings, but more importantly, how about going into 26? Because frankly, at this point, a lot of people are turning the page and looking towards next year.
Yeah.
So from your recent travels, what can we learn? What have you heard?
Ryan, I can start with Boston,
Yeah.
and you can take it if that's okay.
Yeah, absolutely.
Yeah, so I was in Boston last week. BMO was put together some property tours. They were great tours. We saw a number of assets, but I'm going to focus on life science because, there were investors there, and we saw the same assets, and we heard the same comments. And some people came away very bullish, and some people came away very bearish, and are even short the stock. So it's kind of interesting, the dichotomy that's happening right there in life science and what investors think. So the stocks are beaten down for sure, and life science is a distressed space right now. You look at Alexandria real estate, which is 100% of its NOI comes from life science. It's down 55% off its peak since late 2021. And then Health Peak, who is about 40% of its NOI comes from life science, is down 35%. So these names have been beaten up, but I I saw signs of early stabilization. I saw some green shoots, I felt, and heard some interesting things. The market, I think, is very bifurcated, and it's a story of haves and have-nots. But I'll kind of just go through and talk about life science, and maybe give the bear and bull case real quick, Dave. So life science, I mean, some of your viewers may know this, the journalists may not, but the space is built around its specialized lab and office space for biotech and pharma tenants, and it's clustered in Boston, San Francisco, San Diego, and that's simply because that's where the best research institutions in the United States and the world are, and that's where the tenants want to be, so that's where the real estate is. And coming out of the GFC, you had a decade of very, very bullish growth. Alexandria had a great run going into COVID, and during COVID, the stocks really did well and took off. And you think about, you had the ubiquitous nature of like vaccine discovery, drug discovery at this time, and also with interest rates low, money was easy. And because money was easy, there were a lot of tenants that were growing through IPOs, through M&A, through venture capital funding, and they needed more space. And as it always happens, the developers were happy to provide it to them, all too happy, and hyper supply happened. So basically, you had office developers who were contending with work from home, and they're shifting to develop life science. And in 23 and 24 alone in Boston, you had 7.5 million square feet delivered each year, which is just a massive amount of supply for that small market. So fast forward to today, and you're at 26.5% vacant in Boston, and you have slowing demand. You have landlords with no pricing power, and you're in the deep recession phase, I would say, of the real estate cycle. And then the question was, are we bottoming out of that, and when does the recovery happen? So the bear case for life science, and I'm going to focus on Alexandria right now because it's the 100% pure play way to play life science, and also the assets are just very well located. It's steps from MIT. Sure, Dave, go ahead.
I just want to add, it's the only way to play pure play life science.
Yeah,
Alexandria.
exactly.
As far as I know, there is no other pure play. They're the only way to pure play it.
That's right. In the public space, we actually got to meet with Biomed, which is Blackstone's life science arm, and that was
Beamer.
Yeah, that was interesting. I mean, it was to highlight the supply. We walk into their office, and right outside there's a project being built. So that was kind of how it felt in a lot of Cambridge. But I will say, okay, in the bear case of this is oversupply and lack of demand. And the bears said, hey, it's not going to pick back up. Why would it pick back up? There's no VC flowing into the space. There's no IPOs. There's no M&As. And then additionally, when you look at Alexandria itself, they have a redevelopment and development pipeline that they're still building. And to fund that, they can't raise equity because of their share price. They don't want to increase the leverage, so they're selling non-core assets. And they're selling about $1 billion worth in the second half. And there's, I mean, execution risk when you're selling $1 billion worth of assets into a difficult market. And then on top of that, you know, you have RFK and President Trump, and they're not known fans of the pharmaceutical industry. So you have some funding pressure that people are worried about in the headlines. You have talks of drug price reform, and there's been cuts at the FDA. So the drug discovery and the drug approval process is slowed down. Despite all of that, we find the story very compelling because we think there's a very low bar to be jumping over for Alexandria in the life science space. I talked about how far down the stock is on a multiple basis. It trades at a wide discount to its history, it's to its peers. In addition to the valuation, you get a margin of safety from a very fat dividend yield of 6.1%. We couldn't believe when the thing went above 5% because, you know, we had seen where it had been before. The occupancy seems to have found a bottom at around 90%. And Biomed actually told us that in the last 2 months, it's been kind of a turning point in the space for leasing. So we think that Alexandria is probably going to be capturing the majority of that leasing that's done in Boston, even though it's still not great, just because of the flight to quality that's happening. People want to be in East Cambridge. They want to be near MIT. They want to be in Harvard. And that's where Alexandria is. And also, what's going on with a lot of these headlines is sometimes the headlines are a lot scarier than the reality. And that seems to kind of been true for a lot of things with this administration. There's an announcement, people get really worried, and then the reality of it maybe isn't, you know, as significant to the business. So NIH funding's held flat, and FDA, you know, the FDA is still approving drugs. So overall, we think it's challenged, but we think, you know, the best investments are made in the most uncertain times. And if you wait until everything's clear here, you've probably waited too long. And the market's going to front run this by 6 to 12 months as it always does. So right now, in life science in Alexandria, we see a lot of quality, we see a lot of yield, and we see it available at a pretty attractive valuation. So we're constructive on the name.
So before I let Rhino get into it, and that was great. Thank you so much for that. I want to mention that just yesterday, I hosted a webinar with Scott Brinker from HealthPeak. And we spent a bunch of time talking about life science because he wanted to address the elephant in the room. So clearly you're seeing, you know, and by the way, when it comes to the world of public REITs and life science, the number of players can really be counted on one hand, right? It's Alexandria pure play, but not pure play. It's HealthPeak. It's Boston Properties, BXP, right? You could almost say it's innovative industrial properties these days, IIPR, because they just made that big loan to IQHQ, right? Yeah. Who else? And the answer is
Kilroy has a little bit, and
Kilroy, thank you. Good call. So this is something that's going to be in focus, and I think you made some very good points that if you wait until it's cleaned up, you've already missed that trade. So that was really a good takeaway there. What about you, Dobro? What do you got for us?
Yeah, I mean, we were, you know, also in Boston. It sounds like we were there.
Not together, just for the record.
A week before Tyler. You know, obviously this is conference season, right? So in September, you know, we had members of our team at the BAML Global Real Estate Conference in New York, which is more commercial centric. I always go to the Zelman Housing Summit, more residential focused, which is also in September. I've been going for almost 15 years now. Obviously, it was more virtual a couple of years ago, but it was back in Boston this year. I did swing through Cambridge when I was there, and yeah, Alexandria owns irreplaceable real estate. I mean, they have various properties there which have been assembled over decades, and you have 2.5 million square feet of contiguous space, and in one case. So yeah, terrific real estate. The other thing, Tyler, they have a really great capital structure, right? I mean, their debt is locked in at a low cost on very long term. So we don't own Alexandria. It's in our shadow portfolio that I mentioned earlier, and we would certainly like to own it at at a price. So yeah, definitely spent some time in Cambridge. But going
Hey,
back to
Mr. Litt's calling me. He wants to talk to both of you guys. He thinks you guys need to have a chat. Hey,
but
Ryan, why don't you talk to us about Zellman? What did you learn at
yeah,
Zellman? Anything from like the single family rental guys or the manufactured housing world?
yeah, I think the main takeaway from that conference was probably the same takeaway from the BAML conference, and that is there is significant divergence across geographies, across property types, even across companies within the same sectors. And if you look at what's going on in the housing market, there are two clear issues with affordability being as stressed as it is. And that's one, new homes are not as affordable as they were 5, 6, 7 years ago. And, you've seen some of the big builders kind of flex their muscles and, buy down mortgage rates to offer incentives, and they've, continued to deliver. But the existing home market, which, that hasn't been available, has been on its back as a result. Existing home sales are, as low as they've been in, 25 years. If you look at it on a per capita basis, it's really, really bad.
Can I
But that's
call
actually,
something out real quick? Can I
yeah,
call? If you look over your right shoulder, I see two
yeah,
ridiculous towers over your right shoulder
yeah,
that weren't there 7 years ago, first
there's,
of all. And so
yeah,
you talk about the rise of cost of housing, and your city that you all sit in is the perfect example of that. Because I know we can't use the word guarantee, blah, blah, blah. Sorry, compliance, but I guarantee the one of those units over your shoulder costs a hell of a lot more today than it did 7 years ago. No question.
yeah, that's fair. If yeah, I think immediately behind me we have some urban multifamily, and then immediately behind that is actually Block 21, which was developed by Stratus Properties, and the bottom half of that just changed hands. They sold it to Ryman, and then the top half of that is condos, which, yes, to your point, are probably at a much higher price point. But there's a lot of additional supply here in Austin, which is really changed the dynamics over the past kind of 18 to 24 months. But just nationally, there continues to be a lot of stress, but that's played into the hands of some of the REITs, right? I mean, with the with the affordability levels where they are, the single family rental options that a company like AMH is providing to market, not only through their existing portfolio but through their development pipeline, those are being met with significant demand, and as a result of that, occupancy is close to 97. So it's been beneficial for AMH and to a lesser extent Invitation Homes.
I was going to say, do you prefer AMH over Invitation Homes because of that development platform that's not necessarily in INVH's radar? Is that why?
There are sort of three angles that we find really interesting about AMH. One, they're really well capitalized. We mentioned Alexandria has low cost debt that's termed out. Prologis has an incredible capital structure. AMH is right there with them. They have probably three of the best capital structures in the space. Two, part of their previous capital structure were basically secured facilities that they used to buy up a lot of distressed homes coming out of the GFC. And those facilities have recently, over the past 2 years, been replaced with unsecured debt, which has now given them the flexibility to take some of their older, maybe non-core assets and sell them into the marketplace. And typically, when you're bringing a single family rental home to market, you can probably sell that at a cap rate that's quite accretive, 3.5% to 4%. So that's interesting to us. At the same time, that the third angle to them is exactly what you said, that development pipeline. For the better part of 10 years, they've built up a really nice development platform. If you were to look at them as a home builder, they're a top 50 builder in the country now, but they're doing purpose-built communities that are for rent, and they are very, very popular. I mean, if you go talk to their tenants, or you talk to some of the home builders that are in their communities about trying to take some of their tenants to come over to the for sale side, you'll find that these purpose-built communities have been very well received. So they've been pretty accretive. They've been building to kind of 6.5%, 7% yields. So yeah, looking out, they have a great runway, sell non-core, redeploy to the pipeline, and then the existing portfolio continues to put up really nice growth, kind of 3.5%, 4% year-over-year rental.
And just for the record, management's going to be very happy that you were calling it by the correct name, AMH, and not old school American Homes for Rent, like a lot of us still do call it that. So kudos to you.
They have.
You've been so talkative in this presentation that I've got a question geared up specially for you.
Let's go.
You guys like the tower, or you guys like the data center side of the universe? What do you see in the world of data centers that we're missing? Why are you guys so bullish on data center guys?
Yeah, definitely happy to talk about that. So just, high level for your audience, there's a lot of data center exposure to be had through REITs, including, as you know, the largest data center operator in the world, which is a company called Equinix. The other pure play is Digital Realty, and I think you had them on a few months ago. And then there's a third company called Iron Mountain, which is not a pure play, but it's very interesting. So I might talk about that one a little bit. But if you
when I think of Iron Mountain, I still think of paper recycling personally. They don't like that I say that, but I mean, it's not just data centers. They also do paper recycling. Don't forget that. So just thought I'd mention that.
That's valid. And I'm happy to talk a lot about that as well, because I do think it's an interesting business. But just at a high level, you have Equinix, you have Digital Realty, and you have Iron Mountain. And if you look at the way that these three names have traded, they've basically traded sideways all year. You guys are aware, of the Equinix Analyst Day in June. There was a 17% sell-off in 2 days, but except for those 2 days.
Wait, for those that don't know, can you address that real quick? What happened? What's going on? What's the follow-through?
Sure. Just one sentence summary. Equinix had their Analyst Day in June. They came out and said they're going to increase their CapEx spend to chase this AI opportunity, and the market didn't like that. That's basically it. But all three of the names, as I said, all three of the names have traded sideways this year, whereas NVIDIA is up 36%, right? So something's going on here. And if you think back to January, we had a so-called DeepSeek moment. And then in February and March, there were rumors that Microsoft was going to be less active in terms of data center leasing. And to be fair, some of those rumors came to bear. The first half of this year was light in terms of hyperscale leasing, and that's industry-wide across public and private. And specifically, I believe Amazon and Microsoft were the two that were less active in the first half of the year than they typically would be over a 6-month period. But then if you fast forward back to today, Microsoft started their fiscal 2026 calendar in July, and they guided to $120 billion of CapEx, which is 3x of their CapEx spend in 2023, the year that GPT was taking the world by storm. So in 3 years, they've gone from 40 billion to 120 billion. They're telling you exactly how much they're going to spend on CapEx over the next 12 months. I think investors can also look to recent deals between OpenAI and Oracle, between OpenAI and NVIDIA. You've seen Google Gemini rise to the top of the App Store. You see what Meta is doing in the headlines. And I don't think it takes a brain surgeon to tell you that data center demand is going to remain strong in the near term. And I believe these hyperscalers, even the ones who were less active in the first half of this year, they will be back to the table in short order. So knowing that hyperscale leasing this year is going to be back half weighting, and having watched these names trade sideways all year and sitting a month out from Q3 earnings, it looks like an interesting setup to me.
Okay. Well, the cool thing is we all got together in June in Austin, had a great barbecue meal at Lambert's. Thank you again. It was great to see you guys. Whenever we see a commercial real estate story these days, it seems to always be focused somehow on Austin, or Austin is always brought in the conversation. And I think one of the reasons is we're still kind of operating in that COVID mindset of what markets outperformed during COVID. Well, as we know, sitting where we sit, we saw a lot of relocation to Texas and a lot of relocation and development in Austin. And we know the markets: Austin, Nashville, Tampa, Raleigh, Charlotte, blah, blah, blah. Okay.
Yeah.
Well, we're here to talk about Austin because that's where you guys are at. My beloved alma mater, Hook 'em Horns, baby. What are you guys seeing down there? What's the long-term outlook for Austin? Maybe we could bring it back to let's say a Cousins with Sail Tower, we could bring it to, I don't know, one of the apartment guys, Mid America, MAA, my apologies. Like, what should we be thinking about when it comes to Austin? Because the story today is different than the story a couple of years ago, and I'm sure it's going to be different a couple of years from now. Rest in peace, West Campus, because it doesn't look like how it looked when I went to school there 30 years ago. Dobro, why don't you kick us off there?
Yeah, I mean, like you said, I mean, it was certainly impacted pretty significantly post-pandemic. I mean, having been down here, like I said, for 8 years, I saw it pre-pandemic. And at that point, it seemed like a lot of the migration here was actually more from the East Coast. But as we came out of the pandemic, it was very much dominated by West Coast, and particularly with some of the tech tenants and employees moving here and the hiring. But ultimately, a lot of those expansion plans got put on hold, right? And so when you look at the office market, it's probably one of the more challenged office markets across the country, with vacancy rates kind of north of 20%. At the same time, on the residential side, things became very unaffordable coming out of the pandemic with that spike in migration. But because we're in Texas and not certain parts of California or other markets which are more challenging, developers met that demand with new supply, both on the multifamily side and on the single family side. And so as a result of that, we've actually seen pricing for both single family housing as well as just overall rents moderate, if not decline, by double digit numbers kind of over the past 12 to 18 months. So that's something that we're not necessarily seeing on a national level, but we have had supply on both commercial and residential, which has led to moderating pricing on both sides.
Al, you got any insights there?
Yeah, Dave, you said West Campus doesn't look the same. This isn't a REIT insight. This is just, you might find this interesting. Between all the studying that you did in college, you said what, 2 to 5 years ago? I can't remember. You ever go to 36th?
Of course.
Yeah. So 36, for people who don't know, is East 6th Street. It's not far from our office or Ryan's office. And it's where all the bars, the clubs, the restaurants, the live music venues in Austin are. That's where Rogan has the mothership. And actually, Stream Realty bought 40 properties in that area, and they're planning to redevelop it. So it's called Dirty Six for a reason. Yeah, see, people feel one of two ways about it. They either love it or they hate it.
Going to get rid of 6th Street. What's going to happen? It's not going to be the same 6th Street anymore.
So what they're saying is it's gonna be a little more mixed use. There's gonna be retail, there's gonna be residential. They're gonna keep a lot of the music venues. They're saying they're gonna keep, I mean, because it's a very historic area. I believe the writer O. Henry wrote about it back in the day. I mean, this is way back in the day. But they're gonna change. It's gonna change the nature of it. It's gonna be redeveloped into something new. It's gonna take years. It hasn't really started yet, but they own those properties. So that I thought that might be your reaction.
Depressing, very depressing. But go ahead.
Yeah, it's just an interesting Austin aside to talk about the development and growth of the city. But when we think about Austin, I think that we had a front row seat to multifamily oversupply in the Sun Belt. Like this was where it happened the most. Just like Ryan talked about, and MAA and Camden have been calling Austin out as their most challenged market. Definitely. I mean, the vacancy rate in Austin right now is 10%. The rents are negative, and it's kind of epitomizes what happened across the Sun Belt. And there's been, a negative couple years of rent growth. MAA just reported again last quarter negative rent growth. People were hoping it was going to grow positive this year. It doesn't look like that's going to happen. It's definitely not going to happen in the back half of the year when leasing is usually softer. But I think there is some good news in that starts are falling fast. Like any metric you look at, construction has slowed down significantly. And absorption is kind of, it's keeping pace at least in 25. And then when you look to 26 and 27, the setup starts to even get a little more interesting. Now the concern has flipped from supply to demand. Is the job growth going to be there to meet the supply? And there's been a couple weak jobs reports, and I think that's where you see a lot of negativity in the names this year in the apartment space. But I think we are constructive on the Sunbelt names. We're constructive, like MAA is the largest owner of Sunbelt properties, and it trades pretty cheaply. It had a good run up last year, but on a historical basis, price to FFO basis, it's cheap to itself and to the rest of the REIT sector. And then one thing that we have really been looking at with these names is like, if you look at the implied cap rate of Camden or MAA based on their share price right now, it's north of 6%. But if you look at where the transactions are taking place, it's low fives. And if you talk to any Austin apartment owner or developer, they're going to tell you they're going to sell that thing in the low fives. And I mean, EQR over the last 2 years has been buying in the Sun Belt, and they've been buying in that range. And I think they know what they're doing. So long term, they see the growth prospects there. They see the job growth there. Supply has been bad, but once again, it's similar to life science where you had a hyper supply phase. The market's in a bit of recession. The landlords don't have pricing power, but there will be a recovery. And we think that the supply picture that's coming will lead to a recovery, probably happening in 26 and definitely in 27 for these Sunbelt names.
Well, in case you guys didn't know, we're already 50 minutes into this. I mean, that's how quickly time flies when you're having fun on these conversations. So we're going to kind of do an all-in-one lump question here, because we've got a global fund manager, we got a local fund manager, and we got that local fund manager that's domiciled overseas. So as a result, you guys are bringing a worldly perspective into this conversation. So as a result, Rhino, I'm going to put you on the spot here.
Okay.
What geographic regions are standing out to you guys right now? Any specific markets? And maybe to lump in another question or two, are there any particular names that's not necessarily on the global scale, but in domestic? Or do any names potentially jump out at you? So let's kind of do a 2-for-1 here with both you guys.
Almost a lightning round of sorts here. So from a
lightning round the S out if you want. Go ahead.
From a geographic perspective, anything stand out? Absolutely. UK. I mean, the UK is internationally, valuations are generally more attractive. And there are certain markets where supply is much more restricted, especially what we just talked about relative to Austin. But the UK, especially anything that's sort of London, Southeast England centric, there's been a lot of volatility in the UK politically. Their deficit is similar to what we're looking at here in the US, and as a result, interest rates have gone up and real estate's been put in the penalty box. And if you look over there, you'll find some of the best real estate companies, we think, globally. They have great balance sheets, great management teams, terrific business models, and they're trading at 35 to 40% discounts to NAV. And over there, they actually, they report to IFRS as opposed to GAAP. So they're kind of reappraising their portfolios semi-annually. And so those 35 to 40% discounts to book are generally reflective of what the underlying value of the businesses are. So if you were looking internationally, I think the UK is a great place to start. And 3 REITs that we're invested in over there that we would certainly stand behind. For anyone spending more time on. One, Big Yellow, they're the leading player in self-storage. 2, we're an investor in Unite, which is the largest owner of student accommodations, and then Segro, which is the leading owner of an industrial, not only in the UK but throughout continental Europe. All 3 terrific platforms. And the one other thing on the UK that's really interesting, we've been investing over there for 20 years. Is that there's a very, very active M&A market. And so if the public markets aren't going to recognize the value in those terrific franchises, the private markets will. Blackstone, Brookfield, a number of other private equity groups that have a lot of dry powder have been very active in the UK over the years. And so with those sort of discounts, it wouldn't surprise us to see some of the names go private if the stock prices, don't bounce back. And then, quickly, any other names to mention? I mentioned Segro. I would follow that with another industrial real estate name, and that's Prologis. I'm sure everyone's well aware of the company. It's the 800-pound gorilla in the industrial real estate space. 3 things that we don't think are necessarily factored in there would be one, the loss to lease opportunity. They still have about $1 billion of cash flow they can recognize as their in-place leases roll. Two, fundamentals for industrial are improving. Supply levels have come down quite a bit. We're seeing some reshoring of certain industries. Generally, people are carrying higher inventory levels, so demand's better than we think that is out there and being discussed in a lot of cases. You're seeing a lot of build-to-suit opportunities. And then three, going back to data centers, there is a terrific amount of demand. Prologis behind the scenes has probably one of the largest global pipelines, up to 10 gigawatts.
Was that Skybox? Is that the Skybox platform that they're involved in?
I'm not sure about their involvement with Skybox, but they did just kind of behind the scenes lift out and recruit a pretty big team, actually, that's based in Dallas. They're doing a lot behind the scenes on data centers, and it might have been related to that entity. We wouldn't be surprised either in their Q3 results or maybe year-end results if they shine more light on the opportunity there. So if you factor all of those things in, we think Prologis is ultimately going to be worth a lot more than where it trades today. So seems like an opportunity to buy an above average business at a below average price here. So PLD's in one.
Before I give it to Tyler, I want to comment on two things. Props to you. Student accommodations, not student housing. That was very good. I did an interview with Dan Letter just a couple of weeks ago in one of our 5-on-5 interviews. And Dan said to me, did you know that $3.2 trillion worth of goods flowed through our properties in 2024, which represents 2.9% of the global GDP? Yeah. It tells you what kind of footprint that they have worldwide. I mean, it's massive. So good stuff there. And I literally had that written on a little piece of paper here. I'm always going back. Tyler, Adya, what about you guys? What markets, what sectors, what names should we be looking at?
Well, I will say, we do have a great global presence, but I would do it disservice if I pitched Japanese REITs or Australian REITs to you here. I mean, I can tell you everything about Austin submarkets and East Cambridge, but I listen, but I'm not quite as knowledgeable there. But I want to pitch our website, www.B&ICapital.com. You can go on there. You can read some of the white papers that our team in Singapore has put out on Asian REITs. We think that's a really interesting space. It went from being overvalued to having a very interesting year. And I would say, as far as interesting ideas, we talked about it originally. We didn't get to go into it. I think one of the more interesting things we're looking at is probably still in data centers. Aditya, do you want to talk about Iron Mountain real quick?
Yeah. So this is a company that was started in the 1950s when the founder bought an old abandoned iron ore mine in upstate New York and started a business using it to securely store records. Now remember, this is the 1950s, so we're talking legal documents, hospital records, but over time, tape, microfilm, everything. This is still before my time, but over time, they eventually acquired 95% of the Fortune 1000 as their trusted records and information management provider. And once they had this moat of, you can trust us with your data, they then expanded into other verticals. So a law firm would come to them and say, hey, you have this truck coming to pick up these boxes of paper. Can you also recycle our old computers for us? And Iron Mountain says, why not? And today they do everything from recycling prescription bottles to decommissioning data centers to even building and operating them. So any context in which privacy and data security are paramount is a context in which Iron Mountain can play and have an edge. And so data centers was the perfect place for them to go, which they started doing around 2010. And Dave, you called me out on this paper storage thing. This paper storage you might think is a dying business, but today they store a higher volume of paper than ever before. And that's something they're able to say quarter over quarter consistently. So this is growing in part just through growth of the economy and GDP. And then you also have regulatory requirements in certain industries. And so the paper storage business is a growing cash cow that they can use to fund intelligent, disciplined growth in new verticals. And the reason I like to highlight this company is because I consider myself a student of Warren Buffett, who popularized this concept of an economic moat. And one of the things that I've learned from him is the mere presence or absence of a moat is not what you're looking for. What you're looking for is companies that can consistently expand their moat year over year. And if you look at Iron Mountain going from just an abandoned iron mine 75 years ago to this multinational company that services the Fortune 1000 all over the world, they have definitely managed to pull that off.
That was good. Who wants to talk about senior housing?
I'll talk about it briefly because I know we don't have much time. I mean, I would just say it's a known story. A lot of people are long the space, but Welltower, the number one player in the space, it traded at 30 times price to FFO last year in October, and everybody said you got to sell this thing. It's trading at 30 times price to FFO, and I think it's up 30% since then. So it continues to just kind of grow into the multiple. It's an FFO, it's a dividend compounder, and yeah, you have an aging population that's only going to grow, and there's virtually no new supply to meet it. So until the supply increases, I think that the fundamentals will increase. And I think one interesting thing they could do that they haven't done and the market isn't talking about is you have a large portfolio of MOBs. It's 10% of your NOI. If they were to sell that, recycle that capital back into the shop, they could buy shop assets, which are going to grow a lot faster at pretty high cap rates. And at the same time, you become the only pure play senior housing REIT in the space. I think that's pretty interesting. And I think the setup for senior housing as a whole is pretty good over the next couple of years, despite the multiples and the premium that it's trading at today.
Yeah. All right, so let's bring a nice pretty bow on all of this. We'll give each of you guys one last parting shot. What's your takeaway from today? What should investors be thinking about when it comes to REITs for the rest of this year and into 26? How would you educate the audience? Tyler, you go first since you're on my screen first.
Go ahead.
You said me, Dave. What would I be thinking about into next year? I mean, I think everyone's focused on interest rates. We got 100 basis points of interest rates cuts last year. Maybe we'll get 100 basis points this year. I don't know, but I don't think it's gonna, be a rocket ship for REITs. And I think that there will be incremental interest, but I think you still have to look at the fundamentals. It's supply demand. It's what it always is. Is the management team, can they be trusted? Are they good capital allocators? Those kind of things. And like I said, I thought my tours in Boston were really interesting, and I'd be looking to see what the life science names, the kind of numbers they post up in Q3 moving into 2026. I think there's a really interesting setup there.
Before I get on to get to answer, how many trips to Dunkin' Donuts did you two make when you were in Boston over your respective weeks?
Not enough.
No answer, no comment.
I didn't go. We went to Fenway, which was awesome, but we did not go to a Dunkin' Donuts, which I guess did I even go to Boston?
Ryan?
I went as much as I could at the airport when I arrived, when I was in Boston, at the airport when I was leaving. We do have a Dunkin' here. It's on campus, but it's just tough to get to. But yeah,
good job.
I like Dunkin'.
Good job, Rhino. Good answer. What should investors be thinking about?
I'm a sucker for donuts, so it's a good thing I wasn't on that trip. From my side, I would just say, real estate houses the economy. Ryan highlighted PLD, 3% of GDP worth of product moving through their facilities. And so you think about
there on that piece of paper, right there.
Yeah, sorry, Dave, that was you. And you think about the thematic tailwinds of the silver tsunami, of aging seniors, or AI. And so I really would just highlight that REITs are an excellent way to play any kind of thematic trend that you're interested in, as well as the general growth of the economy.
Ryan?
Yeah, it's, going back to some of the comments about interest rates and, capital potentially coming into the sector, given the valuation, that's all very, very positive. The sector itself is much better capitalized and better managed, I think, than it was 15 years ago. I mean, if you were to look at debt levels, on average, they're probably down by, 10% across the board, but it's still a capital intensive industry, right? I mean, real estate is capital intensive. So the one thing that, we would certainly emphasize is that if you're looking at real estate companies or the sector as a whole, to make sure that you emphasize those companies that are well capitalized, because real rates are still higher than they were 3, 4, 5 years ago. So as a lot of these companies are refinancing debt, they're refinancing debt at higher rates. And to the extent that you're not getting revenue growth to offset that, you're not going to get the cash flow growth and dividend growth. So certainly focus on companies that have low debt levels, that also, have some pricing power, so that they can, drive cash flow, drive dividends, drive value higher. And PLD is certainly an example of that. AMH is certainly an example of that. David, if we can do this again, we could certainly talk more about manufactured housing. There are a lot of good things going on there related to Sun Communities and ELS, and those are the types of businesses that are going to continue to drive value higher in our view. So we'd focus there.
Well, on the screen here, I have your respective contact information. If anybody wants to reach out to Third Avenue, to B&I, to myself, if you want this presentation, just send us a message. We're happy to share the presentation with you that we were running in the background, not on the screen. Ryan, Tyler, Aditya, I can't thank you enough for spending the past hour with me, sharing your thoughts about the world of REITs in Austin and commercial real estate, and for today and beyond. And we should get another one of these on the books because, man, an hour just zoomed by. In fact, we have a longtime REIT IR person that all of us knows that just came into the room at the end of the conversation. They're missing out. So we'll get to share this with them. But guys, thank you so much for this. And I look forward to doing it again with you soon.
Thanks for having us, Dave.
Yeah, I've really enjoyed it. Thanks, guys.
Hang with me one second.